Welcome, PI listeners. I have a great guest today. First, let's talk about why we do this. We do this for investors that are looking to understand how to get involved with real estate passive investors. And that's not real estate passive investing. It's probably any action step you take to invest in. Today, I welcome back Greg. Greg, we're running it back. Thanks for coming back, man.
Yeah, it's good to be here, John, especially, during this environment that we have going on here. Very interesting times.
Absolutely. And me and Greg, we wanted to run this back just to, touch on a few things that's going on in the market. And Greg, if you can give us a little bit about your background, just so we understand who you are.
Yep. So I'm a real estate developer. I've been in the business since 1997, started out as a remodeling contractor, built that into one of the largest building companies in our area in 7 years, and to a $30 million business, sold it, and have been focused on real estate development and investing. I've started 12 different companies during my career, most of them, during that 7-year period as well. And so, I'm opportunistic. I like to build ground up. I like heavy value add. I like taking old buildings, making them new. And then I coach and mentor people, and I've got clients all over the country doing different things in the commercial real estate sector, as well as in equity capital and things like that. So I've got clients that have billions of, $1 billion assets under management, some with several hundred million, and some that are, just getting started and headed in that direction. So I get a good look of what's going on all around the country and all of the different asset types and classes.
Thank you for sharing. If anybody wants to know a little bit about more about Greg, we've already interviewed him in a previous episode. That's why we're calling this one, we're running it back. So Greg, it's safe to say that you've seen different market climates, right? So can you touch on all the different type of climates you've been through?
Yeah. So I was heavy real estate back in 2009 when we saw the Great Recession. I was not in business during the S&L crisis. Prior to that, I was in the Navy, went in the military right out of high school. So I missed that, but I understand what that was. That was a banking crisis, savings and loan crisis. We came through that. So I caught the tail end of the upswing in 1997 when I started that company and started investing 97 through 2000 when things were really shooting up. And then 2008 and 9, we had the banking crisis. And that's the main difference between now and back then. 2008 and 9 was a banking crisis. It was everybody was borrowing money. Real estate was over leveraged. Properties were not worth what the loans were on them. So it was just easy credit. It was just really crazy time, the subprime mortgage thing. So that was a banking liquidity crisis. So the banks were collapsing. What basically happened was all that money was out on the streets in real estate assets, primarily in the residential sector, that were worth half of what the loans were. So that created a real problem. So that's kind of what took down, a short version of what happened in 2009. Very different than now. So we were overinflated prior to all of this happening. Going into last year, stock market was all-time highs. Real estate prices have not exponentially increased. We're kind of back to where they were pre-boom. So 04, 05 was kind of the peak of the market before the crash. So we've kind of gotten back to those levels, but it's not crazy. We haven't exponentially grown, especially in relation to the interest rates like we did in 2009. So real estate was fairly healthy. There were some types of properties that have become overinflated, like multifamily, self-storage, mobile homes, some commercial retail office assets, very competitive because of the low interest rate environment. So really, it's all relative. Back when cap rates were 7 and 8, interest rates were 5 and 6. Interest rates dropped down into 3s and 4s. Cap rates dropped down into 4, 5, and 6. Institutional funds, life insurance companies, pension funds started direct investing, so that drove cap rates down. Instead of lending, a lot of them were becoming direct investors. The family office world is getting more and more into direct investment. So there's been a lot of cap rate compression over the last few years, but with interest rates and structures of the deals, they were still able to cash flow. So that's what happened in 2009. What's happening now, obviously, is we're just shut down economically, right? So everybody's out of business, in the retail, hospitality sector, airlines, manufacturing. I mean, there's a lot that's going to come out this week in terms of unemployment. I mean, it's going to be in the millions. The real effects of what we're seeing right now, we don't even know yet. I mean, it's just too early to tell. It's all going to depend on how far and how long this goes, what the real results are, in the long term. The good news is the big difference between now and what happened back then is back in 2009, the banks were not on board. The Fed was not on board. It took them forever to pass any kind of legislation. All it did was bail out, the big banks in Wall Street. It didn't help any of the regular people. They weren't able to work out mortgages with regular individuals. So the regular individual that was losing their house, they couldn't call their bank and say, hey, can we adjust the interest rate? Can we, move something to the back of the loan? They were just foreclosing. They were not doing it until the legislation passed, and they passed the toxic asset relief program, and they, loan modification program and all that. But even then it was too late, and it only helped certain people, and you still had to qualify. And by that point, you were already in default, your credit was ruined, and you weren't able to work your loans out. So it was just a mess. So what's really cool this time is, like, one individual in particular, Neil Kashkari, he was with the Treasury back in 2009. He knows exactly what they did wrong. So he was on 60 Minutes this Sunday, and he came out and said, look, we have unlimited funding. We are going to print money and pump as much money into the economy as we need to keep from what happening in 2009 happening now. So the government's backstopping everybody. So it's making a big difference this time around. Now, in terms of getting money to people, there's not really much they're doing there or can do, but there is unemployment. They're expanding those benefits. There are loans for people who can qualify, businesses. So those are going to be in place. But again, there's going to be a lot of boxes you got to check. You're going to have to qualify. So they're not just going to write you a blank check. So, there are things that you have to do. And there's stuff on the Small Business Administration and the government's website for unemployment benefits and stuff like that. But at the end of the day, the Fed is there to back the banks up. So if you own property and you have properties that are struggling because your tenants can't pay rent, whether it's commercial or residential, the good news is the banks and your personal residence. So if you're struggling financially, you lost your job, you can't pay your mortgage, the banks are going to work it out. And right now they're saying, look, we'll give you a year, meaning we'll defer payments for a year, add them to the back of the loan. They didn't do that back in 2009 because they know if they don't do that, our economic system will collapse. It will go away, and there's nothing anybody can do. So this time the commercial bomb and the residential bomb would drop if the Fed did not come in and do what they're doing. So they're buying bonds, they're buying debt, the commercial mortgage-backed securities, they're providing liquidity there, they're guaranteeing the banks. I mean, they're propping up this economy to the truth. I mean, this might be a $5 to $10 trillion thing at the end of the day, depending on how far this thing goes. I mean, we're probably approaching 5 right now in terms of the real effects of what they need to do. So that's kind of where we're at. So that's the good news. The government's behind it. They're saying, hey, we're going to do whatever it takes. They just got to work out the details, right? But the banks are being propped up. So they're going to work with people who owe money. So don't panic. Don't worry about that. You're going to be able to work your loans out, work through this. And if you are a borrower, with a house or whatever, they're going to work with you. So no worries there.
I love the high level view that you just threw out there. Now, let's talk about what operators are doing, such as yourself, and then we'll walk it down to the investors.
Yeah. So in terms of, what I'm doing and advising my people to do that are still, my people are still active, still closing deals, buying properties, underwriting, building their teams. And that's really what I help people do, is grow and scale their business so they can raise bigger capital, bigger dollars to do bigger deals. And I'm helping one of my clients hire some people right now and build their team. I've got another one that's closing on a couple of deals, and I've got people that are in the middle of some deals. And, some of those bridge lenders are backing out, but the life companies are still lending. Balance sheet companies are still lending. So you just want to be careful now in your due diligence. Number one, you don't want to go hard with earnest money anymore. You want to dig a little deeper into the T3, specifically the T3, so that you can verify economic occupancy and, vet those tenants. Where do they work? Are they working? How many of them lost their jobs? So, everybody, you just want to be transparent. The landlords, the sellers are being transparent. The management companies are being transparent. They're reaching out to tenants. They're finding out, and specifically as we get into April, this is March right now, whoever's watching this whenever, March of 2020, when we get into April, we're going to know more about layoffs and who's really affected, and, particularly end of April into May. So you really just want to have your due diligence checklist in place so that you can scrub, the numbers on the T3 to verify economic occupancy. You want to make sure that you know what's coming down the pike, and you want to underwrite the deal with the assumption that you're going to lose potentially, depending on the asset, multifamily, let's say, 30% of your income. So you need to be able to carry that property and have reserves if you lose 30% of your income. Some assets you might lose 50% or more in the multifamily, depending on the class and your tenancy. Commercial and multifamily, or commercial retail office sector, you might lose it all. So you're buying, basically, some of them are going to be vacant, some of them are going to be close to that. So you have to factor in the cost of lease up and the time to hold those. So those are almost those are going to be the opportunistic deals that, I'm kind of waiting for some of these things to go dark, where you could come in and repurpose them or, lease them up and things like that. Really good sectors to be in right now, that seem to do well in every environment. Obviously, multifamily will survive. People have to live somewhere. Storage always seems to do well. Depending on how deep and how far this goes, storage could be at risk, because if people are truly desperate, they're going to not pay that storage and they're going to sell everything in there. So that, depending on how far this goes, that could potentially be a problem. If people need to liquidate, that's going to go. But, again, what are you going to lose? 50% of your tenancy, of your customer base. So as long as you're prepared for that and you can weather that, that's what you look for there. Now, some of the best spaces to be in right now are government guaranteed leaseholds. So if you have any kind of a government service guaranteeing the lease on your building, that's a great space to be in. Medical's a great space to be in. Gas stations, once we get mobile again, people need gas, people need food. If you own a grocery anchored center, the grocery store is not going anywhere, especially right now. Pharmacies, they're hot right now and they're going to continue to be. And then industrial, third-party logistics and, last mile distribution centers. So, that's where like your Walmart distribution center product goes before it hits the retailer. So any of those types of warehousing services in and around distribution areas, hubs, Amazon type third-party logistics and distribution centers, those are great industrial assets to own. So those are the types of things that I'm looking at and that I'm advising people to kind of take a look at and just, keep moving forward. Be careful, give your closings a little bit more time to happen, because a lot of lenders working remotely, it's taken longer. Some properties you can't get into, to view the rooms and to view, the units and things like that. So you got to account for the delays and things like that. So that's why you don't want to go hard with your earnest money. You want to drag out your due diligence and your closing at least another 30 days. So I'm telling everybody minimum 60 days due diligence, 90-day close versus 30-60. Or 45-60. So that's kind of what I'm having everybody do right now. And most sellers understand it just is what it is. If the seller needs to sell, they're going to accommodate.
That's awesome. So let's say you already have assets. What are you currently doing and putting in place right now with all the mandated work from homes and stuff like that going on? What do you guys?
So, if it's multifamily, generally, the blanket, be safe, stay healthy, stay clean, wash your hands, we're working, your property management companies, if you're using property management companies, are going to have their standard, COVID-19 bulletin that they're going to send out. And then in general, you got to work with your tenants. Okay. And you just got to be creative. So you don't want to proactively say, hey, if you can't pay rent, you want to wait for them to come to you. What you want to do is send the message, hey, we're here to work with you. We're here to help you. Whatever your needs are, let us know. Reach out. Be careful, be safe, be clean, social distancing, all that stuff. But as people start reaching out and say, hey, I can't pay my rent, I lost my job, you got to work that out with them. Now, each individual owner, it's going to be up to them what to do and how to handle that. And, obviously there's no eviction policies in place. There's probably going to be some rent controls on increases in place. There's probably going to be some other things coming down the pike to help people that are in a situation where they can't pay their rent. So I'm not sure what those rules and laws look like, but what I'm telling everybody is, look, work with your people. Don't even worry about evictions. You don't want to evict anybody that's lost their job, right? So what you want to do is whatever you can work out with your lenders, pass that down to your tenant, and then you've got security deposits that you can use to offset rent, things like that. So obviously you got to let them know, look, the rent is due no matter what, but we're going to help you get through this and maybe defer that. They sign another year and it gets spread out. So there's a lot of ways to be creative with those tenants. If it's a retail center or an office environment, that's different, right? So if they're gone, they're gone, and, they may not be able to reopen, unfortunately. So, that's a different situation. There's some businesses that aren't going to be able to hang on. So, trying to do whatever there just isn't going to help anybody, and it's just going to delay the inevitable. But, if you've got a retail tenant and they can't pay and you can't put anybody else in there right now, then, just let them stay in there and let them continue to do what they can do until, they just can't do it anymore. So every situation is going to be different for everybody. So, make sure you follow the guidance of your property management companies, make sure you follow the guidance of the government, and then, do the right thing, help people, work with people. And, the lenders are going to work with you, expecting you to work with your people. And that's the other thing. So these loans, the conditions of these loans that they're giving to businesses is they're saying, look, you can't lay employees off. The loan workouts with you as a commercial property owner, they're going to say you cannot evict your tenants. Retail, office, those things are different, but, residential, whether it's single family, multifamily, whatever it is. If you get a loan mod, a loan workout, they're going to tell you, they're going to make you sign a document that you're not going to evict people. So, those are the types of things that you got to watch out for and be ready for.
Oh, that's awesome. Thank you for sharing that middle component of everything that's going on. So now we're going down to touch on the investors, right? So if I'm an investor right now and I got capital and I wanted to previously deploy it in an opportunity before all this happened, how should I go about the situation now?
So, again, you just want to be careful and vet that opportunity a little deeper. Make sure that you get the due diligence from that sponsor, whoever's raising the capital. Make sure you vet the team. They've been at it for a while, that they've got good reserves, that their portfolio is not currently in trouble, and that things are going well. So, and you want somebody who's going to communicate with you through these times. But there's still opportunities out there. There's still deals getting done. So, if you have the cash to deploy, then that's great. If you don't, it's going to put pressure on you. Then I would hold it right now and just kind of wait and see where we go. But if you've got excess cash and it's not going to affect you or change anything, then just be smart about it. Make sure that you understand the market, the asset, and the operator, whatever that is. I would not play with the stock market right now unless you just have been in it and you know it intimately. And I would not invest in any business you don't know intimately or understand right now. In a time like this, in an economic time like this, you don't want to make investments in anything that you don't understand, you've never been involved with. So you want to stick with what you know, where and just kind of wait till this whole thing blows over. And if making an investment in something is going to put pressure on you, just don't do it. Just keep the cash and just wait.
That's awesome. Thank you for that sound advice. Now, Greg, you said you're waiting for certain opportunities to just kind of fall into place. Are you going in and you're going to buy these all cash? Are you going to leverage debt? What is your plan?
It depends on what that looks like down the road. Cash is always the best position to be in. And from a capital standpoint, my resources are unlimited. So, initially some of those deals may end up, being taken down with cash and then a refi on the back end. But it depends on what the capital markets are going to look like and what the lending environment looks like on the other side of this. It should be good. It should be healthy and rates should be good. But we attack with cash and then, recycle the capital later is kind of how we do it. So it really all depends. What I do know is there is a lot of capital looking for opportunities right now. So I'm patient with the big guns. I'm hold on, we're not there yet. But I'm getting calls every day, man. What's out there? What are you seeing? I have dry powder. I'm ready to go. So, I've got a backlog of that ready to deploy as soon as we get through, but it's just too early right now. We're not in a position to make really good decisions. And these opportunities haven't presented themselves yet, but they will.
That's awesome. Greg, this was a state of the market kind of podcast episode. I want everybody to go and listen to his podcast, Greg Dickerson podcast. Go and subscribe to that. Matter of fact, if you do subscribe to it, do this for me. Give him a 5-star rating. Give Greg a 5-star rating, man. He's awesome. You heard what he just spit out for you guys. Greg, do you got any closing parting words? Anything you want to leave us with?
Well, just be smart. This will blow over. We'll get through it. Things are going to, I don't know what the new normal is going to look like, but things will get back where they were. The sooner we get back, the better and quicker it's going to be. The longer it goes, the longer it could take and the worse it could be. So, we just don't know yet. But what I do know is there are still deals out there. There are still, everybody's, lenders are still lending. People are still looking to invest, and there's still deals and opportunities. So you want to keep doing what you can do. Be smart about it. Hedge the downside. Make sure that you're adjusting risk and you're watching every day because it's changing every day. And just be smart about what you're doing. But don't be afraid. Keep moving forward. If you need help, if you're in a tough spot, there's help out there between the SBA, unemployment, things like that. There's people hiring. The distribution centers are hiring. Walmart, their stores, their distribution centers, the pharmacies, grocery stores, delivery services. There are jobs out there. So there's freelancing that you can do on, Upwork and things like that. People are looking for virtual assistants all the time. So there's a lot of different things you can do to earn money right now. Landscapers are all ramping up and hiring. Construction is still moving forward in a lot of areas. They're looking for, if you don't have any skills, laborers, painting, drywall help, stuff that doesn't require serious skills, just labor work. So there is stuff you can do out there if you're in a tight spot, and there is help and resources. So, don't be afraid to ask and reach out.
So, Greg, you touched on from the top level, we're pretty much in a safer place and they can handle it. They got a plan this time going on.
Yes.
And then for operators, there's due diligence. Make sure you're going, especially the trailing 3 months, right? The T3. And for investors, really do your due diligence, right? And
Yep.
invest in something you understand. That's the
Exactly.
3 biggest takeaways you hammered today. Where can we find you, Greg?
So yeah, gregdickerson.com. That's my website. All my contact info and social media stuff's on there, YouTube, podcast, all that, like you mentioned. And everything is there. And like I said, we're just watching it every day and see what happens.
Hey, you guys heard it here first. Greg, my first repeat podcast guest.
Awesome.
One of my favorite guests, man. I appreciate you. Your time
Yeah.
is everything to me, and I appreciate it. Thank you.
Well, thank you, John. I appreciate you having me back.
Nah, I appreciate you. Guys, go and listen to his podcast. You heard it here. Subscribe to his stuff. He's an awesome guy. Greg, thank you again. PI listeners, thank you for listening. Appreciate you.
Y'all be safe.